Hey investors, in today's video we're going to be talking about the top 5 ETFs you need in your portfolio to take advantage of compound interest. But before we can begin, we need to talk about what ETFs are. ETFs are exchange traded funds that follow an index. So let's say, for example, you want to invest in the S&P 500 index. Well, there's ETFs that follow this index, such as the VOO. The S&P 500 has on average returned 8 to 10% a year. If you do that over 40 years, so let's say you start with $10,000 and you invest $150 monthly. Over 40 years, that's going to come out to $1.2 million. You see how crazy compound interest can be? That's why it's considered the eighth wonder of the world. So there's more than just one index. There's the S&P 500, right? And then there's the NASDAQ, the NASDAQ 100, the Dow Jones, and many more. If you want to get better returns than the S&P 500, you might be able to do that with the NASDAQ or the NASDAQ 100. And these are fairly new indexes in the last 20, 30 years. So over the last 20 years, if you would have invested into the S&P 500, you would have had a return of about 500%. But if you would have invested in the NASDAQ 100, you'd about have a 1,500% return. If we're wanting to maximize our returns, we should go for those more aggressive growth indexes. So if you're going to want to get higher returns, you might have to take on a little bit more risk. But with these ETFs, they're pretty risk proof because the companies are always going in and out of their portfolios and they're following a specific index, so you still get a good return. So if you're wanting to retire wealthy, ETFs are the easy go-to if you're wanting to sleep soundly at night. So there's more than just one index. There's the NASDAQ, the NASDAQ 100, the Dow Jones, and many others. So if you're wanting to get better returns than the S&P 500, you might want to look in the NASDAQ 100 or the NASDAQ. Over the last 20 years, the NASDAQ 100 has crushed the S&P 500 by more than triple. So depending on your risk appetite, you might want to go for the NASDAQ 100 over the S&P 500. The reward is significantly higher. Even though these are ETFs, there is some risk depending on boom and bust periods, on one's going to perform better than the other. But these are ETFs which companies are going in and out of all the time, and it is following an index which is going to grow. You don't have to worry about individually picking a stock and then having it go to zero. An index is not going to zero. So you might be asking yourself, why would I want an ETF compared to a mutual fund? The reason is because of expense ratios. Just like gains compound, so do fees. An ETF's expense ratio can be anywhere between 0.01 to 0.75. A mutual fund's expense ratio can be anywhere between 1%, 2%, 3%, and even higher. If you were to invest in an ETF starting with $10,000, contributing $150 a month for 40 years with a 0.01% expense ratio, 0.02, 0.03, over those 40 years, your fees would only be a couple percentage points of your investment. Compared to a mutual fund, if it had a 1 to 2% expense ratio, over those same 40 years, you would lose 30 to 40% of your gains. And why would you want to do that? Especially when these mutual funds have a hard time even beating these indexes. Just like us individual investors have a hard time keeping up with the indexes as well. So now that we know what an ETF is and we know a little bit about compound interest, let's dive into the top 5 ETFs you need in your portfolio.
The number one ETF you need in your portfolio is the QQQ by Invesco. The expense ratio is 0.2%. It has a dividend yield percentage of 0.58%. This ETF tracks the NASDAQ 100 index, which is a very high returning index. You can see the return here is high, the risk is above average, and the Morningstar style box says it's a large growth. So if we were to go over to the chart, you can see that if we were to compare this ETF to the S&P 500, it's almost tripled the returns. This is why it is a high return ETF. So if we were to go to comparisons, compare it to another index, compare it to the NASDAQ 100, you see it's in line with the index of the NASDAQ 100. You saw the S&P 500, you saw the NASDAQ 100, let's see what else there is. Let's say the Russell 2000, it's crushing it. You can see that this is a very high performing ETF with a low expense ratio that is going to maximize your returns. So this is why I'd put this as my number one ETF in my portfolio. The second best ETF you could have in your portfolio is going to be the SCHG by Schwab. you can see the expense ratio is 0.04%, so you even pay less in expense. It has a dividend yield of about the same of the QQQ at 0.52%, large growth, and this ETF tracks the index of the Dow Jones US Large Cap Growth Total Stock Market Index. You can see the risk is average and the return is high, and Morningstar gives it a 5-star rating. So let's check it out on the charts. Compared to the Russell 2000, it's about the same. S&P 500, about the same. Compared to the NASDAQ 100, you guys remember that where that was at, it's getting stomped. This is still a high-performing index that is going to maximize your returns. The third ETF you need in your portfolio is SCHD by Schwab. The expense ratio is 0.06%, dividend yield of 3.14% because this is a dividend ETF. It is a large value style. Risk is below average. Return is high. 5-star rating by Morningstar. And this ETF tracks the Dow Jones US Dividend 100 Index. So let's check out its returns. This is a dividend paying one, so this is going to be for more people looking to retire and live off their dividends. This isn't going for aggressive growth like the other two. So let's compare it to the S&P 500, and S&P 500 outperforming it, but this is on 20 years. This has only been around since 2010, so let's check that out. 2010, it is about the same. So this ETF is going to be for people that want to put their money in this ETF and live off the dividends. This is not trying to get capital gains, grow like crazy. This is just so you can live for retirement. The fourth and the most popular ETF everyone has, and that I would put in my portfolio, is the S&P 500 ETF. In this case, this is the VOO. This ETF tracks the S&P 500 index. The risk is average, return is above average, 4-star rating, and you can see it's a large blend of growth and value. The dividend yield is 1.45%. Let's check it out on the charts. So if you had it compared to the S&P 500, you see it's perfectly in line over the last 20 years, perfectly in line since inception. Compared to another one, let's say we compare it to Dow Jones, it's beating the Dow Jones. If you guys remember, NASDAQ 100, the NASDAQ 100 is beating it. The fifth and final ETF you need in your portfolio is the IGV by iShares. This is the highest expense ratio on the list at 0.4%, barely pays a dividend, but it has an average risk, average return. And the reason why I'd put this in my portfolio is because software is becoming bigger and bigger part of our society, and it has great business models. You can see that this ETF tracks the S&P North American Expanded Technology Software Index, and let's check it out on the charts. So it's following the NASDAQ 100 compared to the S&P 500, beating the S&P 500, and let's just check the NASDAQ. So it is beating all these major indexes or staying in line with them, and that is a great thing to see. If you included the expense ratio, it'd probably be more in line with the S&P 500. So you can see the IGV is beating the S&P 500 and it's beating the NASDAQ. But if you were to include expense ratio into this, it'd probably be more in line with those two. Nonetheless, this is still a great ETF to have, and I would definitely keep it in my portfolio.
And with that being said, we are all done now. I hope this video has helped you out. Please like, share, and subscribe, and leave a comment down below which is your favorite. Peace.